Thank you very much for being supportive shareholders, and hopefully we can kind of give you a bit more information today. I appreciate there may be different levels of understanding or knowledge on the fund, so apologies if we do repeat some things but hopefully there'll be some new information in there, certainly on some market insights, and that you'll find that useful. But anyway, yeah, so you've got Keith is here to my left. I'm Robert Crayford. We're the primary fund manager on this fund. Ian Francis is also part of the team, so he heads up New City Investment Managers, which this fund falls under. But yeah, we'll kind of break out in a bit more detail. And if I come through, a bit of sort of general blurb, but yeah, I mean, just as a bit of a backdrop on the fund, so about 160 million gross assets. I guess the key part here is over on the right. You can kind of see some basics just around how the fund is structured. Clearly a heavy weighting towards oil and gas. We'll definitely talk through the subsectors within the fund and diversity and the opportunities we see. Just on the number of holdings there, I mean, what you can see is a fairly concentrated top 10 at around 44% of the fund, and a larger number of holdings. So within that does it does end up looking larger than the reality. Within that, there are some warrant received replacements and things like that end up to a degree of double counting. So just sort of factor that in. There obviously is a tail aspect to that below that kind of top 10 or certainly top 20 where some of those positions are smaller. Yeah, so we'll carry on. So just, I mean, quick backdrop. Keith, as I said, to my left, I'm Robert Crayford, and we've got Ian Francis. So between us, the four funds that we run are a bit over 500 million sterling, but we're part of CQS, which is sort of a larger asset manager, sort of better known in London, I guess, for the hedge fund business, but the reality is most of the assets are now long only. So CQS as a whole has an AUM of over $16 billion. So we get to leverage off that infrastructure, which is clearly a benefit to us. So the fund we're going to talk about today is CQS Natural Resources. It's an investment trust. It's closed-ended. We think that offers us benefits there in allowing us to focus on value over liquidity. So within that, we have a bit more of a mid-cap bias. That means we can really focus on where we think we see the best opportunities. We don't own things like Rio, BHP. We think shareholders are able to do that themselves. We try and offer exposure to companies and assets that otherwise aren't easily accessible for a UK investor. So performance over the last 5 years, we've used here as a comp versus MSCI World Mining, MSCI World Energy. As you can see, the performance has been strong. We put that down in part down to flexibility we have within the allocation of the portfolio. So whether we are weighted towards base metals or energy. Going back a couple of years, you would have seen a much larger weighting towards base metals and specifically copper. We rotated that into energy. We currently have a high energy weighting, which I'll touch on in more detail, and the relative outperformance then of energy following on from a prior outperformance of base metals has been one of the primary drivers there of that relative outperformance. And we'll talk through more detail of why we think there are further legs to energy, and we still see an opportunity and why we're weighted in that way. So I mean, the mandate of the fund is ultimately to invest in resources. As I discussed, we do have flexibility, but really what we've seen is the world shift, and actually what's become a resources focused fund has actually become quite thematic. So there's a number of aspects to that, but the reality is there's some real market disconnects that have become evident, and that's driven by government policy, by investor policy, in part down to ESG constraints, and then also heavily disciplined management teams. So a real focus towards dividends and buybacks, and ultimately that all feeds into one key theme, which is supply remains constrained. At the same time, demand continues to grow, and you've got these sort of emerging markets, the likes of India, which demographically continues to grow, and economically, China still remains a material factor, but ultimately, demand growth does remain. Yeah, so really, I mean, these are policy-led things that we think lead to sort of a key thematic within this sector, and this ultimately all feeds through to stronger for longer, both in absolute pricing of commodities, but also margins for those commodity producers. And we're also seeing, particularly in the case of energy, that many of these certainly don't feel overheld, to us, in part because of those constraints institutional managers have had on holding things like fossil fuels, given ESG pressures on trying to sort of label funds as Article 6, etc. Yeah, so I'll move on from there. Yeah, just a bit more detail on the breakdown. You can see fairly diverse on commodities and asset classes. So how the portfolio is split, but ultimately those key themes remain relevant whether you're looking at oil and gas, whether you're looking at uranium or base metals. There's been a real constrained supply or investment in new supply scenario for certainly since sort of 2015, and that's leading to constrained supply going forward. On the sort of regional weighting, you can see we've got a heavy weighting towards North America, and that would primarily be sort of, well, Canada and US obviously, but that's just down to the nature of where a lot of these assets are based. Energy wise, heavily North American weighted, and similar sort of on the base metal side, and uranium. Canada is obviously a sort of front and center on that. We've got the top 10 there, which I'll kind of break out in a bit more detail, but I guess the key thing to take away is how energy weighted it ultimately is. So within that, we've only got Leo Lithium and Emerald Resources, which don't ultimately fall under energy. We include shipping, which in this case BWLPG, which is it ships propane ultimately, so it's very much linked into the US energy supply story and continued growth of propane, which is ultimately shipped to Asia. But you can see the top two names there. So you've got Precision Drilling and Transocean. So these are oil and gas drilling companies. They own rigs. Yeah, so Precision Drilling is more onshore rigs and Transocean is more offshore. We'll touch on that in a bit more detail, but just to kind of give a bit more color on kind of market caps on this. So 6 of these top 10 would be north of £1 billion sterling. The smallest one would be Leo Lithium, about 330 million. So when we say we are kind of smaller cap, we're not talking kind of UK micro cap. These are proper material companies with strong cash flows. EOG at the bottom there would be the largest of these, with a market cap of around 60 billion, and a number of these, well, Diamondback is about 22 billion. Quick chart there. I mean, ultimately just stating commodities perform well in stagflationary environments. That is certainly an environment that certainly feels possible, given the current backdrop we have. Yeah, so the key theme, I mean, I kind of touched on it there. Energy is the key theme in the fund. We've got the largest weighting we've had since Keith and I have been running this since late 2015. Yeah, so 47% of the fund focused on energy. That's including uranium. You can see 35% oil and gas, 7% uranium, 5% coal. The reality is it's actually probably higher than that if you include the shipping component, which is obviously tied into those flows. So that'd be about another 6 or 7% on top of that. Key reasons for that. Key reasons for that is ultimately that government policy that we talk to and general focus, which we believe is having a greater impact on supply than it is on demand. So you're seeing supply being constrained by policy, yet demand continues to grow. So some of the example names down there at the bottom, we can kind of touch on those in a bit more detail, just slightly conscious of time. But yeah, so renewables, this chart on the right, you can see renewables in that bottom wedge there in green. They are growing, they do continue to grow, but still only represent about 7% of world energy supply. They are ultimately variable. There are requirements for that, which we'll touch on. They do continue to grow, but it's from a low base. So trying to cut fossil fuels aggressively at this point, they need to ensure that they have sufficient other options. And that's why we think ultimately energy markets remain tight and why we have such a heavy weighting towards it. So oil and gas, 35% of the fund. Yes, so yeah, key thing here is the reality is the market's in deficit. So depending whose numbers you use, we put a chart here on the top right. This is from Morgan Stanley, so they're looking at all observable oil stocks that they can see, globally, and they're pointing towards, or they think we're currently seeing about a 2.9 million barrel per day deficit in oil supply. So that's versus global supply of about 100 million. So that's quite a large material number. Yeah, at the same time, we continue to see oil demand grow. So it's still projected to grow about 2 to 3 million barrels this year, and looks likely to continue into 24, 25. So yeah, the reality is we're still seeing stronger demand. OPEC estimate this to be about 3 million barrel per day deficit. Currently, we're starting to see that feed through into global stocks, which are now declining. China's reopening post-COVID, slightly stuttering, but it's still leading to stronger demand growth for energy. So yeah, ultimately supply remains constrained. We've had cuts from OPEC. We've had, we look to the producers, still focused on capital returns, so that's dividends and buybacks. And yeah, government policy, ESG pressures continue to constrain supply. So yeah, our belief and certainly our view is that yeah, demand will remain, margins will remain, and we've kind of focused here via focusing on those names that it's hardest to see a supply response. So you can see that in the top four or 4 of the top 10, which would include the drilling names. You've got Transocean and Precision. You've got shipping names such as sort of Euronav and Frontline, BW LPG. These are kind of big steel, big infrastructure type assets. And ultimately, given the uncertainty they have there about the longevity of future supply, they simply aren't getting funding, or they aren't ordering new equipment. So if you look to offshore rigs, there just isn't the motivation to order new rigs, even though day rates are very strong, and you're seeing a real transition on earnings. And ultimately, this leads to a scenario where you have a market that's artificially tight because of policy, and we think that presents an opportunity for investing in these names. I won't dwell on this, but this just focuses on the US side. So this is US onshore rigs versus oil price. What you can see there is even though the oil price has been stronger and kind of pushing up towards the 100 level, around 90, we're just not seeing a response from the US producers, even though they're seeing strong returns and strong margins into activity. And that means supply remains constrained, and that means prices remain supported. And we focus here on the US because that is the quickest response of supply, which is why it is important. And on that, I will pass on to Keith.
I'm Keith Watson. I work alongside Rob managing this fund, and I just wanted to pick up the baton on the next subject. The nuclear market and uranium is a favourite subject of mine. I could tell you now I could talk to you for an hour on this subject, but in the interests of keeping it brief, I'll try and limit it to a few points. A few of you may already know, if you didn't see it on the slide earlier as well, that Rob and I also run a dedicated uranium and nuclear power fund called Geiger Counter, and I would encourage you all to take a look at that if you have any interest post this discussion here. As Rob said, it's currently 7% of the fund. The crucial factor which is driving this market at the moment is the sea change in sentiment back in favour of this sector, as governments, the public, with the exception of the belligerent Germans, recognise that it is the only carbon-free source of baseload generation technology. After 10 years of bear market post-Fukushima, supply has fallen below demand by a comfortable margin. You can see the green line at the top represents the well understood demand. It's very well understood which reactors are online and when, and that is quite a predictable expected chart. Supply has fallen because the price made it uneconomic to produce, but demand remains strong, and that's driven by a couple of key factors. One is growth in Asia, especially from China, which has continued to build capacity. And since Xi's mantra of bring back blue skies, they've seen an acceleration in the number of reactors built on annually from 6 to 8 to now around 8 to 10. In the next decade, they'll be adding some 21 reactors currently under construction. They have another 47 planned and another 150 plus at the proposal stage. Adding to their current 55 reactors, they will overtake the US to become the largest nuclear power market globally by the end of the decade. The other crucial factor, though, is that those governments in the established nuclear regions of, in particular, the US, currently the largest, but also the EU, have done their volte-face and have now extended the lives of those existing reactors that they have. And that has given a much greater certainty on the longevity of consumption by those reactors, with the result that by the end of this decade, we'll be facing something like a £50 million per annum supply gap for the industry. Crucially, finally, the more favourable shift in government policies has really clarified the operating landscape for the utilities. And we've only just really started quite recently to see the price move up to the incentive level to bring on the necessary greenfield projects to fill that 50 million supply gap occur latterly with the return of utilities to the contracting market. And we must recognise that in this sector, unlike perhaps fossil fuel power generation, the value of the fuel in the electricity produced is relatively minor, as a result of which the demand is fairly inelastic to supply to price changes. So whether it doubles from here or not, it doesn't really have that much effect on the demand outlook. And for that reason, this is one sector that I think we have to pay very close attention to. It really has been reinvigorated. The main exposure to this was on the top 10 list that Rob referred to earlier, a company called NextGen. It has one of the highest grades, the highest grade project globally. It's located in the well-established uranium mining jurisdiction in Saskatchewan, Canada, a friendly allied nation to the west. And it's got a scalable, lowest cost production profile that makes it globally strategic as a uranium mining asset. And it's a position that will hopefully continue to run. We still feel like there is a lot of tailwind behind this sector, with extra impetus given by the return to premium of the physically backed uranium trust called the Sprott Physical Uranium Trust, which is now in the market buying in a liquid conditions and driving the price up. So we've got some good momentum to that one. Sorry, there was a bit of a delay there getting the next slide up. I would say, though, that we do take a broad approach to the energy commodity side, and I don't want to pretend that we're all old economy. We do recognise the potential in the new world and energy transition that is one of the key themes that, again, was referred to earlier. But I think we would like to say that our main focus and the message here is on energy storage. That's the missing link to enabling a much improved renewable grid loading that really is the holistic ideal of much of the sadly ill thought out initial policy that governments try to put in place. In this slide, we would just note that we really concentrate in this sector on things like lithium, which are pretty well understood in terms of their use in EV batteries, also rare earths. There are very few rare earth producers outside of China, which is one of the dominant producers of those metals, but they are used in magnets. And then we've got things like nickel, which is an important ingredient, particularly in as a cathode in batteries. But we're quite specific of what type of nickel and where that is located as to when we're investing it. I think, though, whilst I'll refer to the chart later, I think it's worthwhile noting the exposure tab at the bottom there, because I think wrapped into the policy changes that are shifting now at a government level, there is recognition that there is still going to be a need and reliance on the old world sources of power, gas, oil, and coal, until such time as we can economically deliver transition green power. And that is one of the key messages underlying Rob's prior conversation about our energy weighting overall. But to give you a flavour for some of the investments that we have, we've pulled out a few stocks here. Apologies for the legends partly missing on these. There's a company called Sigma, which is a lithium now producer, which we invested in some 5-6 years ago, which is the dark line there. Its Canadian dollar share price is shown on the left-hand scale. There's Lynas, which is an Australian listed rare earth producer, the main one outside of China, which we again invested in actually prior to this chart beginning, post a restructuring, that produces praseodymium and those key magnetic ingredients. Also with an Australian dollar share price on the left-hand scale. And then we have another nickel sulfide developer located in the US, which has recently signed an offtake partnership with Tesla for the supply of nickel, which is a crucial ingredient into the batteries of that manufacturer. And you can see the share prices of these particular companies. I would say we do keep an eye and are mindful on the slight shift in transition at any cost to transition at sensible cost. We did actually take some of our very significant holding in the likes of Sigma back down, and we've redeployed some of that partially into Leo Lithium, which actually was a win in terms of where that came from, in that it was a spin out from a gold investment that we held, which we felt was completely overlooked in that investment. And again, I think that brings us back into just trying to recognize that there are some real benefits to the closed-end structure in allowing us to invest in the less liquid names that other funds just simply are unable to do. If I jog forward onto the next slide, that's worked. I'd say one of the other noticeable changes that has taken place in the portfolio is an increased focus by us on precious metals as a store of value. I think, as we outline on the title here, there's an increasing reason to own gold. One of those, certainly it's back as a topical subject at the moment, as the US goes through the second iteration of trying to upwardly negotiate its debt ceiling, is the parabolic increase in levels of global debt and how that will be funded. If we look back to the January renegotiating, we saw something like 31 trillion of US government liabilities, and the Congressional Budget Office, using a 3% interest rate on government borrowings, was estimating that the interest cost as the current bonds mature over the next couple of years will rise to 1 trillion. So the government in the US will shortly have to issue 1 trillion worth of debt just to pay the interest. And we'll see the US debt to GDP next year, on that assumption, move to over 100%. And typically historical studies say that when you get over 90, the interest cost starts to act as an impediment to productive investment in the economy, and it becomes a little bit of a self-fulfilling drag. However, just remember that this is based on Congressional Budget Office assumptions of a 3% interest rate, when next year we've got an average expectation of 5.25%, and then 10 years out we've got 4%. And if they're going to have to issue $1 trillion of debt, who's going to buy it? Because the other noticeable factor, as shown in the top chart there, is that latterly China has moved to being a net seller, as we've seen the world in part dissociate, fragment, move more nationalistic, and the dollar become viewed slightly more suspiciously. Certainly China has started to move away from that. And if they're not the biggest buyer anymore, then who is going to be? And I think even the CBO, the Congressional Budget Office, recognizes that it's probably going to be the Fed. So I think that raises issues on fiat risk longer term. And it's perhaps no wonder that therefore at the bottom, we've seen quite a shift in terms of central bank demand for a diversified reserve base. 2022 saw record central bank buying over the last couple of decades. And even though investment flows, which are shorter term on physically backed ETFs, saw net sales, buying by central banks more than tripled that value. And so that's stickier hands if, as we may get in the next 6 to 12 months, a short-term peak in interest rates, perhaps we'll get a return of interest from the physically backed ETFs, which, whilst gold is held up, might prompt a little bit more of a price performance from it. But precious metals, we've tried to add some exposure to it. I'd say initially we had some limited success in that cost inflation was such that margins for some of the producers held back the relative valuations of these companies. And this chart on the right really tries to display why we view some exposure to this sector as probably a sensible decision. The yellow line represents the gold price, which was marched up against the background of rising debt, inflation pressures. But what's happened behind the scenes is that the valuations of equities are basically at trough levels over the period of time for which we have data. The blue line at the top there shows you the price to NAV, assuming a 10% discount rate, and spot gold price for the large cap companies is a bit rich. That's where the liquidity is. That's where the big funds dabble. But as we move down into the red developers, medium-sized companies, then we've got some of the green, smaller weightings, and then the smaller companies again in terms of market cap and real developers, then these are hugely attractive. And for that reason, we view this as a sensible and cheap insurance. Whilst we've had to fight a bit of a margin battle, I'd say that latterly we have seen some of those cost pressures that have affected the gold industry in particular via labour in a restricted Western Australian market, for example, start to ease. So hopefully that headwind will start to be reflected in some potential re-rating of those small caps that we are invested in. I should say the less liquid names that we're invested in. I've moved on to base metals. I would say that the supply dynamics and demand dynamics are very similar to those that Rob outlined in the energy space. But I think that the demand for this is less discretionary. It can be put off, and base metals are relatively easy to store if needs be. But there are some risks out there. And on one of the earlier slides, we discussed some of the scenarios. There's inflation, there's stagflation, there's Goldilocks. I'd say at the moment, we would say there's a slightly higher risk of stagflation because actually the growth that we're seeing is more nominal than real. And there are some factors in the macroeconomy that are really holding back the recovery in broader demand, not least of which is the Chinese property slowdown, which has continued to drag on. But with Western markets battling against high energy costs and uncompetitive manufacturing, China's export markets are also being dragged back by that. And as a result, we're slightly cautious of having too much exposure to base metals. And at 11%, this is probably one of the lowest exposures that we have known whilst we've been looking at this particular fund. And arguably mirrors the the high energy weighting on the other side of that same coin. One of the key factors in terms of the property sector, though, is that on the bottom left there, I think this is a very instructive chart. Rob mentioned we don't look at BHP or Rio. We don't have any iron ore exposure. And if we look at the orange line on this chart, this has pushed forward what has been a rapid decline in new starts in the Chinese property market by around 2.5 years, which is the lag time for completions, and gives you an outlook of what we should expect in terms of metal demand into that sector. And the black line shows you the completions which have yet to follow suit. The outlook is still fairly bleak for the Chinese property market. It's most relevant for the iron ore market, but I'd say also gives us some slight concern over things like China's domestic copper demand, because around 25% of that goes into completions for things like air conditioning and final mile grid connections. So we know the names we like, the likes of Ero Copper in Brazil. We held, and what used to be one of our largest positions was First Quantum, but that's been pared back quite considerably because of the view that we have towards the slightly more cautious view towards overall demand in the near term that's been exacerbated by rising interest rates as well. If I jog forward a slide, sorry, I'm hoping there's a bit of a lag. We move on to shipping. I will not labour this at all, but this is displaying the exact same dynamics. The chart on this slide basically shows new orders which are at record lows. No one is adding capacity, and with policy strangling production of traditional fossil fuels, it's desperately needed in places where it's not produced, and they're recouping the benefits in terms of day rates and cash flows on an exact same theme that's affecting broader supply of commodities. In conclusion, I would say that we have got exposure against inflation, whether that be in a modest or tepid growth environment or stagflation. The theme that we really like about this fund is that it's closed end. We are able to invest in much more attractively valued, illiquid issuers that others just cannot play in. And that has given us some very good returns, as outlined by some of those previous slides in the likes of Sigma and so on. We don't really see much benefit more broadly in terms of owning iron ore that's dominated by a cartel, which you yourselves can buy separately to this fund in any event, even if we did like it, probably more cheaply than owning it through this fund. We think that the supply constraint, which has seen supply shrink much more rapidly than any demand destruction, but really hasn't shown itself to much magnitude in energy, certainly, will last for some time, hence our waiting. And I would say that that is now really, really being reflected in the cash flow returns and the cash flow and shareholder return conscious corporates, as a result of which this year our revenue income from dividends will exceed our payout and exceed the 15% allowable budget that we're allowed to put to reserves. So we're in a good place, we think, in terms of generating income for you. And that's it in conclusion. And I would hand back, if we could, to Q&A.
Thanks very much, Keith, Robert. It was a very interesting presentation. If I can just remind delegates, if you'd like to ask any further questions, just click the Q&A button and you can type your question into the box there. Okay, let's have a look at the questions we've got so far. So first of all, Tim asks, with so many aspects of the supply and demand of natural resources and forever changing global events, how do you make your investment decisions? Bit of a broad question, that.
Well, we've clearly got the thematics approach, which we're given on the early slide. I'd say though that we do have quite a like-minded approach to our process. So having picked out themes, having picked out commodities or trends that will benefit from that, we then do screens globally on those investments that would best suit the response to that. And clearly that we would prefer to be in the better value names. And that's certainly the end of the spectrum that has come really home latterly with some of the great returns that we'd seen. But there's a good process, and I'd say it's on valuation with a bottom-up approach to that, encompassing broader macro themes.
Thank you. Next, Roger asks, with big oil and gas companies so lowly valued, at least on high yields, why would I be interested in smaller companies in that sector at this time?
Yeah, well, we entirely agree. I mean, we tried to make that point earlier that actually holding energy companies has led us going up market cap. You know, we talked through there. We had EOG, $60 billion. We've got, yeah, you had Diamondback there is 22 billion. You've got Transocean, second largest holding is about 6.5, 7 billion. You know, Precision arguably small at just over $1 billion. I mean, yeah, you can go and buy. You could go and buy Exxon, also attractively valued. I mean, yeah, but the reality is we think these are more attractively valued, both on earnings multiples, both on future scope and growth. Yeah, as we touched on, we think the fundamentals behind, you know, owning the kind of big steel means that there's a real hurdle towards replacement and adding new supply, and we think there's just much better torque into that market. So, you know, even under a flat to marginally stronger commodity price scenario, you could really see material talk into those as it feeds through to earnings and deleveraging of existing balance sheets. So yeah, it's all effective risk reward. You know, I wouldn't say, you know, only some of the majors is a bad investment, but at all, because valuations are attractive. But you know, you do ultimately end up being kind of tied into more regional politics, whether that be kind of European you know, led windfall taxes, etc. So it's all a like for like. This is just our preferred, and we're certainly not small cap in that area.
Thanks. A couple more questions from Tim. I'll just rephrase that first question. Do you use much leverage? And if so, what is the average interest rate and maturity of any debt that you hold?
So we do use some leverage. We're allowed to lever up to the 20% levels, and when we have a strong view, we do so. At the moment, I'd say we're roughly midway, for, you know, about the 10% leverage level. We still see some very attractive equity returns, and we don't see any reason really to pare that too much. You know, particularly given our stance in terms of energy, which has been reflected as well by a return of cash in the form of dividends, and we feel very well set in that sense.
Yeah, I mean, I'd add to that. So we get very attractive rates from Scotiabank facility. So we get very low risk premium applied to that. But obviously, you know, it does tie in as the risk-free rate increases, the effective cost of holding any leverage has ultimately increased, and it does make that decision important relative to whether, you know, holding this small level of gearing relative to position sizing. I mean, the reality is the names we hold can easily pay dividends way ahead of where that is, and that's even on a 50% type payout kind of structure. So, you know, it's the reality of many of these names might be tracking at, you know, 15, 20, 25% type free cash flows. So relative to what's being paid on interest level, you know, it's certainly comfortable. Yeah, clearly it does kind of shift that paradigm of that decision ultimately.
And so you mentioned that you have a relatively low interest rate with Scotia. Can you give an indication of the premium you're paying over the base rate for your debt?
I think that's 1.25%.
1.25 over.
But it's based off the. I'll check the form. I don't think it's LIBOR. I think it's another form of LIBOR.
Probably Sonia is
Yes, it
typically
is.
used these days. Yeah, thank you. Okay, and is there a maturity date on that loan?
There is a renegotiation annually on that, which is provided by Scotia.
Yeah, but I wouldn't expect there to be any problems with that. With this, it's from the bank's point of view, it's a pretty low risk loan that they're making, given the asset backing that they've got in your company.
Yeah, I mean, even in a scenario where that was just pulled overnight because you had a banking crisis or something. I mean, firstly, it's not going to happen, but we could cover that in easily within an hour.
Mm-hmm. That's always good to know.
Yeah.
Okay. Right, and Tim is also asking, does the company pay a dividend, and if so, what level of dividend cover do you have?
Yes, we do pay a dividend.
I think it's 5.6 pence. And we pay 3 equal installments, Q1, Q2, Q3, and then a slightly larger final. But you will find this year that, well, the board have to decide what to do. We will have a surplus revenue account over and above the 15% that UK investment trusts are permitted to put to reserves.
Yeah, I mean, yeah. So actually, we're seeing very strong dividends and returns from strong free cash flowing businesses. So, North American companies are generally a bit more buyback focused, but yeah, I mean, still we're seeing very heavy dividends, particularly from shipping industry.
Thank you. Then a couple of questions from Geraint. What are your thoughts on precious metal royalty and streaming companies versus the miners?
Yeah, so this is kind of a longer question that we could spend time on. So, yeah, ultimately we like both. We think both are well placed. Clearly the risk reward offering is different. Certainly downside risk is more protected because they're not exposed to kind of capex in the same sense. But there are risks that are present. Ultimately, the valuations are also quite different as well. So, yeah, we generally focus more on the mining side, just because I think we can add more value there. I mean, I'm a geologist by education, so Keith did physics, but similarly, we've been looking at mining companies for a long time. So we like to get into the weeds and into details on the assets, and we kind of feel like that's where we can add value. And then ultimately, it's just down to a relative value call. There are periods we own royalties, and we do have some exposure still, and there are periods that we'll kind of reduce that down and hold more mining stocks. I mean, we're definitely more on the mining weighted towards the mining side. It's just a relative risk reward, but ultimately, royalty companies are generally more expensive. There are some smaller ones that are less so, but the royalties are higher risk. So yeah, sorry, a bit of a vague answer, but yeah, kind of difficult one to kind of pinpoint.
Yeah, as you say, it's potentially a very broad question, but I think that's fair. Thanks. Okay. And coming back to the dividends, Geraint is saying that the dividends have tended to be fixed historically. I think based on your previous answer, there's a possibility, as you say, depending on the board decisions, that they could increase. And as you also point out, you have to pay out 85% of income that you receive, net income. Want to make any further comment on that?
I don't think there's much that we can add, really.
No, thank you. That's fine. Okay, and then Tim is asking, do you use FX hedges? Do you manage foreign exchange risk in any way?
Yeah, we don't. So we think there's sort of some natural hedging within it to a degree, because ultimately you own assets that, well, the assets aren't held in sterling, but ultimately everything kind of ties towards a kind of dollar type revenue and cost model for resource companies. Sorry. But yeah, so we don't actively hedge. We think that isn't our strength. Our strength is in looking at companies and analysing them directly. We think you get kind of natural hedges from assets. So, let's take it for silver miner in Mexico. They inherently have a sort of degree of natural hedge there, because if the currency weakens, that kind of feeds through. To lower costs and helps on the margin and kind of offset on that side. So, yeah, we kind of take more of a holistic view to it, and rather than direct hedging.
Thanks. So I think that about covers the questions from the audience. There's one question I wanted to ask you, particularly on the mining side. You indicated you're more focused on small and mid cap companies. That can be a bit of a minefield. In choosing which are the decent companies, what are the sort of key characteristics you look for in what you think is a reliable business to invest in?
Yeah, look, it's not straightforward. So firstly, there is asset quality, the geological quality of the assets. There's regional risk. There's a question earlier about how we apply that. We obviously have to have a keen view on global geopolitics, regional geopolitics, and implications that has therein, particularly in a world where sanctions are regularly applied as well. So, how do we view that? So, the largest caps, so your Rio BHPs are obviously heavily iron ore weighted. We're obviously quite cautious iron ore, so there's a bit of a commodity. Well, there's a commodity view within that as well. But yeah, ultimately it's management teams, it's asset quality, and it's regional, geopolitical risk, and kind of overlaying all of that. So I'm always cautious of saying this because it kind of sounds a bit cliche, but we kind of take a top-down view in how we kind of allocate across the commodities that we like. But ultimately that's then offset by a bottom-up view. So in some cases we like the top-down on the bottom-up. Energy would fit that because we like the way the energy market is heading, but we also like the valuations of the equities. So copper, for example, we like the top-down longer term, but we don't particularly like the bottom-up because they all look relatively expensive and there's near-term risks. And this is just our effective view and why we've allocated as we have. But on single assets themselves, I mean, it's ultimately how you risk it. So we're very cash flow driven, focused. So ultimately, to put it into the sort of dumbest sense, I guess you're looking for an NPV, you're looking to kind of DCF an effective asset value, and within that you apply different risk weightings for smaller assets because the risks are higher, both on operational risks and the potential to fall down, versus multi-asset companies, and we kind of do that trade-off. We're generally a little bit more comfortable with country risk. We think a lot of generalist fund managers are very adverse to taking on any country risk. There can be periods that's okay, and periods it can have knock-on impacts, but we think the valuation differentials are pretty extreme. So you can see that with our holding there in Leo Lithium. It has an asset that's similar quality except open pit and underground to a company called Liontown in Australia. Yet the market value differential is about 7-8x relative to where it's trading, just because it's in West Africa. So it's all effective. Yeah, it's that kind of bottom up relative value call versus risk. Clearly we'd rather own assets in tier 1 jurisdictions with zero political risk, but it's a valuation trade-off of what we think is reflective.
Yeah, often you don't find the best resources there, unfortunately. No. You often have to go to jurisdictions you'd ideally prefer not to invest in.
Say that we would tend to prefer those companies that have the ability to operate through the cycle. So typically that does look for grade as a generalization. It's not always that. There can be other factors that will play into it, but that's a consideration that we also take into account.
How much importance do you attach to quality of management teams?
A lot.
Yeah, that's my experience too. It's crucial to find good ones. Okay, well, that was a very interesting presentation. Thank you very much, Keith, Robert. It was, as I say, most useful. Really appreciate that.
Thank you, everyone.
Thank you very much.